Greetings, members, one and all of the Salivation Nation. Banks are making huge profits off the gold market. Let's explore. Yes, indeed, fascinating. This is an article that comes to us from mining.com, and it covers a very interesting topic related to bullion banks and how much they are making as investors pile into the fractured gold market. This article was shared with me by one Miles. Fascinating indeed. As we get into this, I encourage you to press that like button with just enough force to turn it blue. Very much appreciated. Does this help the algorithm to get the information out there? Banks are making huge profits from gold as investors flood into a market fractured by the coronavirus crisis. The world's largest 50 investment banks are on track to double their income from precious metals this year to around $2.5 billion, most of it from gold. Coalition, a banking consultancy, told Reuters. $1.2 billion was the earnings pool last year. This year, we are already crossed that number, said Coalition Research Director Amrit Shahani. The juicy rewards, which have not previously been reported, mark a stunning reversal of fortune for bullion banks. In March, some had to wipe hundreds of millions of dollars off their trading books as a global pandemic snarled the supply of gold bars. That disruption sowed the seeds for the current bonanza. Stung by the losses, many big banks lowered their trading limits on the COMEX exchange in New York, which is the biggest gold futures market, creating a lack of liquidity that pushed prices there above prices in London, the main hub for trading physical gold, and elsewhere. So there is, and I'll tell you what, that gives you some, it's pretty complex what's going on up there. Of course, we're going to talk about with the gold futures and how that's doing that. This is, in a way, I guess in a sense, is another example of manipulation, I guess, to kind of save their butts, so to speak, here. The divergence created a lucrative opportunity for banks who have the infrastructure to buy metal outside the U.S. and deliver it to New York to profit on the difference, especially during a pandemic, when investor demand has pushed gold price to record levels of around $2,000 an ounce. Reduced trading by large banks also drove prices of later dated futures far above near dated ones, an opportunity for those with gold to sell it forward for more than enough money to cover the cost of storage capital. The confluence of events has created a boom in profits on COMEX, 13 sources at banks, brokers, and funds told Reuters. It's free money, said an executive at one of the largest bullion trading banks. You know, it's interesting because there has been supply disruptions, and that's kind of interesting looking back up here. It is related to this. I think that's kind of what makes this a bit confusing because of the global pandemic snarled the supply of the gold bars. And so that's why the trading limits were lowered in order to do that. And then the supply kind of came in. So this has created these profits. And we can see here from this chart, we see the bank profits from precious metal more than double in 2020. Their net revenue really started in 2019. And of course, there's really no, so I was seeing where the line is right there for 2019, and this is January. We saw these revenues in millions of dollars starting to climb then. So that was before the pandemic, which makes this a little bit even more confusing. Even banks that reduced activity on COMEX are making more money there than before, industry players said, none of whom was authorized to speak to the media. It's double the profit on half the position, a second banker said. Banks, some hedge funds, and asset managers that did little or no business on COMEX have stepped up their activity, sources said, and data from CME Group, which runs the COMEX exchange, showed. Here we see the open interest fell as gold prices rose. In this chart here, CME provides little data showing activity of individual actors on its market, but numbers that are available show banks including Goldman Sachs, Morgan Stanley, and Citibank have ramped up trade in gold in vaults registered with the exchange in recent months, either delivering metal or accepting bars which they can sell forward. We talked about the deliveries of gold to the COMEX increasing greatly in our prior video. Lenders such as Wells Fargo, BNP Paribas, Royal Bank of Canada, and Barclays have also made or taken deliveries of gold against futures contracts after long periods of little or no activity, with profits running high not only from COMEX but also from trading, financing, and storing gold outside the futures exchanges. Some banks are hiring. Deutsche Bank is adding a third person to its recently revived precious metals team, four sources said. Revived after their trial here that I guess maybe even still be underway for manipulation and spoofing. Citi, Bank of America, French lender Natixis, and Australia's Westpac have also hired in precious metals this year, according to sources and LinkedIn profiles. The banks either declined to comment or did not respond to requests for comment. I wonder if somebody was going to ask them about spoofing, if they're cracking down on that in their establishments and institutions that are growing in the precious metals market here, or divisions of their banks. We have seen strong growth in our precious metals markets this year as new and existing customers use our products to manage uncertainty in today's global economy, said CME's head of metals, Young Jing Chang. So this is a cash and carry opportunity. Before the pandemic struck, banks such as HSBC and JP Morgan that dominate gold trading would buy metal in London and hedge their price risk by selling futures on COMEX. This allowed them to create liquidity in both places, but rested on assumptions that gold could quickly be shipped to New York if needed, and that prices in the two markets would remain close together. Those assumptions fell apart in March when the virus shut supply routes. The link between London and New York ruptured, prices diverged sharply, and activity fell in both markets. And here we can see an example of it. Here in March, what happened? And divergence. COMEX total volume with a 5-day moving average, and London total volume with a 5-day moving average. And here we can see their volume in March. Interesting indeed. And then we saw that separation. Futures prices became unmoored from London rates, sometimes trading cheaper, but often $20 or more an ounce higher, and higher still compared to Asian countries. And that was something I remember very distinctly. In fact, many bullion dealers were starting to quote, and local coin shops were quoting futures prices instead of the regular prices. With supply routes now reopened and the price premium outweighing the cost of making and shipping bars, which bankers say has ranged between 50 cents and $10 an ounce this year, more than 700 tons of gold worth some $45 billion at current prices has moved to New York since March. It's a lot. And that is something that we've talked about in the past in a prior video. Before the influx, vaults registered with exchanges held less than 300 tons. So that's quite a big of a demand and movement of gold, more than double. Flows of gold to the United States have begun to ebb, but another money-making opportunity also opened in a transaction known as a roll, in which every few months, investors in futures must swap expiring contracts for later-dated ones. That's interesting. To swap the February 2020 contract for the April one costs around $6 per ounce of gold, CME and retentive data show, or around $240 million total for the roughly 400,000 100-ounce contract trading. Wow. Another layer of complexity to the futures trading market. When the London futures connection broke and banks became reluctant to sell in unlimited quantities, the price rose. And that's natural because of what was going on, because of the insuranceness of it all. To roll from June to August costs around $15 an ounce on average. The longer 4-month roll from August to December costs $25 an ounce, or $1 billion in total for 400,000 contracts. A boon for the seller. The market is costly for futures buyers. There is no free lunch, said a source at the large U.S. bank. Somebody has to lose money along the way. Those people with long positions are every time paying money to those willing to take the other side. The scope for big profits has attracted more sellers in the market, from smaller banks to hedge funds and asset managers. A further uptick in future supply could eventually temper profits, particularly if it's accompanied by a drop in demand. But in the meantime, banks are coining it, both by managing their own trading books and facilitating trades by new entrants. The amount of business we've done with hedge funds around this is unprecedented, said one banker, adding that his desk profits from gold were already double last year's total. It's glaringly obvious cash and carry opportunity, especially with these rolls. They make money off the futures. Now they're making off the extension of the futures into the rolls. I tell you what, it's something. So when you got that much money embedded and out there to hedge your bet on gold, well, it's in their interest that it stays up, I guess, right? So maybe that manipulation might be working to some extent on that regard. And it depends on how you define manipulation. But a lot of this is these natural market forces. But you know what? People could be jaded by this and gold could crash. Then realize, hey, this is not what I want to do. I'm going to get out of this and eat my losses and get away. And that kind of thing, especially considering what we have been dealing with the last few months, and especially if the economy were to recover. And by the way, that is something that is a distinct possibility. Make no mistake, let's separate the economy from our overall economic health. Those are two different things in terms of what we're doing with debt and deficit spending in this country and modern monetary theory, which will have an effect on the economy in due course as long as people begin to lose faith in the dollar. But who knows when that is going to be, and who knows how that's going to play out, especially if the dollar remains strong. Because like I said in prior videos, the dollar is utilized for transactions between 60% of transactions of 60% of nations around the world. The dollar is used. It's in their interest that it remains strong for their transactions. And that is something that is propping up the dollar in a sense. There's a lot of psychology in this as well. But you know what? These banks are making a lot of money off of gold. And more likely, there's not a whole lot of physical to show for it. At least for those people that are buying these rolls and these futures. That's what they do. They buy on the futures of the market. They don't actually hold the physical. As for me, that's not how I roll. That's not how most of us roll here. We get the physical. That's right, the physical gold metal itself. There's no counterparty risk. It is what it is. It's the value of the metal contained therein, really no matter what the price is in due course. But it is the ultimate hedge against economic instability, and even with shenanigans, kind of like what we're seeing here, and with supply chain disruptions and panics that we're seeing there, I believe that gold will hold its own through all that and come out on top on the other side as a wealth preservation tool, an asset there. And to me, that's really what it's about, and the beauty of the metal itself. So there you go. Interesting and fascinating indeed. Thanks again to Miles for sending this along to me. Post your thoughts below. I'd like to extend a multitude of gratitude to you all for watching, and encourage you to please rate, share, comment, and subscribe.